Now, today I'd like to talk about the non-farm payroll update we had last Friday. Now, the US non-farm payroll surged by 275,000 in February, surpassing the anticipated 198,000, presenting an apparently robust labor market at first glance. However, if you deep dive into it, there is a significant downward adjustment totaling 124,000 for previous months, dilute the impact of this growth, effectively whittling the net gain to a modest 150K only. So you cannot just look at the whatever is given to you at the time. You have to look at the revision. But we know that anything above 200K is something okay. It's acceptable. Previous month we had 300 plus. This month 200 is above that 200 mark is okay. But then there is this part where I see there are adjustments, okay? And these adjustments are not minor adjustments. They're huge adjustments. They're above 100K, right? So adding to concerns right over here when I see this kind of adjustments, right? Over the last 2 months, payroll revisions have been dramatic, including a substantial upward correction of 117,000, and that's just last month. Now, such significant revisions raise concerns about the data collection accuracy, emphasizing the necessity of considering a broader spectrum of labor market metrics instead of relying solely on payroll figures. Okay, so we need to start look into other things like jolts, for example, and then the wage, for example, all this kind of stuff, the unemployment. We need to use all this because now when there's revision and this revision is like in the 100K difference, we're going to question the accuracy and the authenticity of this data that's coming. Does it represent the real market situation? All right. So it's becoming increasingly important to monitor for potential patterns of rising unemployment and stagnant wage growth from now onwards due to this conflicting, revisions that we are getting. Anyway, current trends, right, indicates a deceleration in work resignations, pointing to a labor market teeming with job vacancies that unfortunately lack appeal, leading to a diminished interest in these positions. Now, this change suggests a decrease in labor market turnover, reducing employers' need to increase wages to retain their workforce, which could further elevate inflation pressures originating from employment dynamics. Now, although subdued wage growth and increasing unemployment rates may not immediately prompt the Federal Reserve to adjust its course, the likelihood of a rate cut in June is rising, potentially followed by 2 or 3 additional reductions in the year. Now, Fed officials in the December dot plot signal an expectation of 3 rate cuts this year, with updated forecasts eagerly anticipated at the forthcoming March meeting. So we have seen the December dot plot. Then when we have the March one, which is coming up, we would have a clearer idea what the Feds are thinking. Are they going to maintain that 2 to 3 rate cuts for this year or not? Okay, so for now, the expectation is for June to be the rate cut, and that is also seen in other leading central banks, leading economies in the world, and the central banks, they have also the same idea. That brings us now to ECB signal June rate cut, right? So the European Central Bank, ECB, has hinted at June as the earliest possible timing for an interest rate cut following a downward revision in its inflation forecast and the anticipation of meeting its 2% target in the coming year, right? So the revision suggests a more modest inflation rate of 2.3% for this year, down from the previous estimated 2.7%. Now, the ECB President Christine Lagarde, in a recent address, acknowledged the progress being made towards the inflation target within the European region. However, she also stressed the need for further evidence to solidify confidence in this trajectory. I mean, this is normal for all the head of the central banks. They always like to leave a back door just in case things don't go their way. Now, despite the positive direction, the ECB has projected a core inflation rate of 2.6% for the current year, and a slight decrease from its earlier forecast of 2.7%. Now, the ECB's cautious outlook on the timing of the next rate cut echoes the sentiments of other leading central banks, right? We have seen that with the Fed already. Now, the BOE is also of the same view right over here. Now, overall, we know that inflation is proving to be more persistent than anticipated. It's always easy to come down from the top, but as we get nearer to the target, we have seen slight increases in the Fed, and then we have seen, like this month, equal kind of numbers coming out. So that shows that it's pretty sticky, right? So this shift in investor sentiments takes place against the backdrop of Eurozone economy that experienced stagnation for a significant part of the previous year, largely due to the ongoing conflict in Ukraine, right? So we really need to hope that this war ends as soon as possible. Both wars, in fact. Lower interest rate generally support higher asset prices. So if both Fed and ECB cut rates, it could lead to a rally in stock markets, though the effect may vary based on the sectors and region. Now, also do take note that doesn't mean immediately it cuts, you will see that rally happening. It will happen, but at a later stage, not immediate, especially if it's bad news who actually brought the market down that forces these central banks to start cutting their rates. Okay. Now, as for the currency, the impact of the euro-dollar exchange rate might be muted, because you have, I think whatever needs to happen already has happened when the pricing in of both the euro dollar as well as the US dollar is happening right now as we talk, right? So depending on the relative scale and market expectations of further rate adjustments, we will discuss more as the time comes. But for now, I think if anything is going to happen, it's going to happen right now. And when it comes to that date where they actually start cutting, probably everything would have been priced in already. And I see things rather muted for the time being, with the both central banks trying to to delay their rate cutting as long as possible until they believe that inflation is on the proper trajectory towards the 2% target. Okay. So that's the end of the report for today, fundamental report.